Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
By now, the holiday dust has settled and we've all begun receiving documents in the mail that remind us that it's time to start thinking about filing our taxes. So we begin looking at our checkbook registers and our files and at our bank statements to gather information. And what we realize is that we have a huge amount of information that has piled up from years of filing taxes. So how long do you need to keep all this stuff? What do you need to keep? And why do you need to keep it? Well, the length of time that you should keep certain records really depends upon what that record proves. You should keep documents and receipts for any kind of income or deductions on a tax return until the statute of limitations runs out for that tax period. The statute of limitations refers to the amount of time that you have to amend your tax return to either claim an additional credit or refund, or that the IRS has to assess additional tax on that tax year. Typically speaking, the statute of limitations is 3 years from the date the tax return is due, or when the tax return is actually filed, whichever is later. There are some exceptions to this rule for the 3-year statute of limitations. For example, if you discover that you have underreported your income by more than 25% of the gross income on your tax return, the statute of limitations becomes 6 years. If the IRS determines that a tax return has been filed and it is fraudulent, or you didn't file a tax return at all, there is no statute of limitations for these tax years, so you'll want to keep those records indefinitely. If you did file an amended return, the statute of limitations is 3 years from the original due date of the return, or 2 years from the date you paid the tax, whichever is later. If you file a claim for a loss due to worthless securities or bad debt, you'll want to retain those records for 7 years. So what kind of records should you keep? Well, individuals should keep W-2s, 1099s, and any other records that support the income claimed on a tax return. You may also want to keep your bank statements, as these are frequently requested for an IRS audit. On the deduction side, you'll want to keep your receipts and really any third-party records that document a deduction that you've claimed on the tax return. Also, be sure to keep records pertaining to assets after you've sold them and after the applicable statute of limitations runs out. These records generally support the amortization, depreciation, or gain or loss claimed on the tax return. Be sure to keep your records in a dry, safe, and fireproof location. You can keep them in their original format in paper, or you can store them electronically, as the IRS typically will allow reproduced copies of records for audit purposes. The reasons you want to keep all of these records, obviously for an IRS audit or a state audit, but also in the case of a creditor dispute or an insurance claim, or maybe for lending purposes. For more information, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.